What's going on, guys? Welcome back to the channel. My name is Anfernee, and in this video I want to talk about how taxes work on stocks for someone who may have been invested in the stock market or may have just gotten started investing in the stock market recently and made a little bit of money, but all of a sudden Uncle Sam is hitting them with a tax bill. Or maybe you're someone who wants to get started investing in the stock market and you want to know how to avoid or to plan for a tax bill coming up in the future once you do make all your money in the stock market. Well, you clicked on the right video because this video is going to break down all of those parts. I'm going to go over short-term capital gains tax, long-term capital gains tax, and overall how you can understand and plan for taxes when invested in the stock market. If you think you're going to find any kind of value in this video, then tap that like button for your boy. And also, as a treat, if you go down into the description and sign up to the public app, they will give you a free stock just for signing up, no strings attached. So when we're talking about understanding taxes and knowing what kind of bill you're going to get hit with come tax time, one of the most important steps that you can take is understanding the difference between pre-tax income and actual gains that you have on your investments, because you can make money in the stock market without actually being taxed on the money that you make. And this happens when you buy security, it goes up in value, but you don't sell the security. Now, for the purpose of this specific example, I'm going to exclude dividends. So for this example, if you buy a stock for $25 and it goes up to $50, if you then decide to hold that stock rather than sell it and take the profits, you won't be taxed on the gains on those stocks. So as I talk about in a lot of my videos, if you are a long-term investor and if you plan on acquiring assets over time, then your stock bill will be inherently low because you are only taxed when you sell securities. And also, the IRS offers an incentive for holding securities for longer than 12 months, as I'll talk about a little bit later in this video. So if you're just getting started, you don't have to stress out about taxes just yet, even if you made a little bit of money on your investments already, because the majority of the taxes that you owe will come out when you actually sell your stocks. And the longer you hold your stocks, the less money you'll have to pay in taxes. And now let's get into talking about the actual taxes. And there's basically going to be two taxes that you're going to need to worry about when you are investing in the stock market. And the first of those taxes is called short-term capital gains tax. And what this is a tax on any investment gain that you have for an investment that you held for less than 12 months. So for example, if you bought a stock for $10 and you sold it 6 months later for $20, you would owe short-term capital gains tax on the $10 profit that you made on the stock that you sold. And you only will pay a short-term capital gains tax if you actually sell. You don't pay these taxes if you continue to hold an asset in your portfolio. And how do you calculate short-term capital gains tax, you may ask? Well, for short-term capital gains taxes specifically, they are taxed at your marginal income tax rate. And what this means is that the gains or the profit that you made is going to be added on to your taxable income that you have from your W-2 job, from your side hustle income, any taxable income that you have in that given tax year. The amount of gains that you have that qualify for short-term capital gains tax will just be added on and taxed at your current income level, just like it was another paycheck. So in this sense, if you were a day trader or if you were someone who is quickly buying and selling securities, then the IRS very much treats this like active income or W-2 income rather than investment income specifically. However, short-term capital gains tax differs from long-term capital gains tax because long-term capital gains tax have a much more favorable tax treatment. And in order to qualify for long-term capital gains tax, you would have to have held your asset for longer than 12 months. And the way the gains are calculated are just the same. You simply take the amount you sold it for and then subtract what you bought it for, and what is left over is the overall gains that will be taxed on. That is not necessarily going to be the tax amount. And long-term capital gains tax are taxed differently from short-term capital gains tax because depending on your income level, long-term capital gains tax typically cap out at around 20%. However, short-term capital gains tax can go anywhere up to 30 or 40%. And as I said, this capital gains tax only applies when you sell your stock. If you plan on holding your security and you don't plan on selling that in a tax year, whether you hold it for 6 months or 12 months does not matter because you only pay the gains tax when you actually sell the security. And one thing I forgot to mention just now is that dividends on your investments are also taxed at a long-term capital gains tax rate. So even if you do receive stock dividends, they won't be taxed at the short-term capital gains tax rate, which is the higher of the two rates. But moving on, let's talk about how to calculate your tax bracket and how to calculate your marginal tax rate, as I mentioned a few times in this video. And basically what your tax bracket or your marginal tax rate is going to be the tax rate that you pay on your last dollar of earnings or your highest dollar of earnings. And how the US has this structure is that the more money that you make, the higher tax that you will owe on the last few dollars. And this is a progressive system, so earners that don't make a lot of money end up paying less taxes, and people who make a lot of money are supposed to pay more tax, but because of some loopholes in the tax law, this isn't always the case. And how this whole system works is basically in blocks. And I'll pull up my phone to show how this whole system works. So basically the US tax system is a system of blocks. And usually when people look at this, they make a simple mistake when calculating what tax bracket they're in. So let's say, for example, we are a single person who earns $60,000 a year. And if we look at the tax bracket, we can see that $60,000 is in the 22% tax bracket, which we would assume that we would owe 22% of all of our money in taxes to the federal government. However, this is the wrong way to calculate your taxes. When you calculate your taxes in this progressive system, you would owe only 10% in taxes on the first $10,275, and then from $10,275, from $4,775, you will owe 12% on that chunk. And only in the $18,000 from $42,000 to $60,000 would you pay 22% tax on. So really your marginal tax rate will be lower than 22%, but they have calculators on the internet to calculate that for you as well. And if we pull up a marginal tax rate calculator, we can see exactly what that is. So as I said, for this example, we're going to say we made $60,000 a year and we are a single filer with no kids. This means that with the standard deduction, our tax rate will only be 10.3%, even though most people make an error and expect it to be 22%. However, I'm going to talk about in a second why knowing your marginal tax rate is important. But now let's talk about the benefit of knowing your marginal tax rate and why even if you don't plan to be invested in the stock market, you should still know what your marginal tax rate is. And this is because if you know what your marginal tax rate is, or if you know how much income that you have that qualifies for your taxable income, then you can then make plans in order to lower that amount so you owe less in taxes. What I mean by this is that if you know that you have a high marginal income tax rate, you can lower this amount by contributing more money to your 401k plan. You can lower this amount by contributing to a traditional IRA, because with both of these accounts, they take pre-tax dollars that would in turn lower your taxable income for that given year. The IRS allows you to contribute $20,500 to your 401k as of the year 2022. So if you made $60,000 from your W-2 job, but you contributed $20,000 to your 401k, you will not calculate your marginal tax rate on the $60,000, but rather the $40,000 after you deducted $20,000 of retirement contributions. So calculating your marginal income tax rate can benefit you in more ways than one. But let me talk about another easy way that you can reduce your taxes by investing in the stock market, and this is going to be simply investing in index funds rather than investing in individual stocks. With index funds, which is basically just a collection of a whole bunch of stocks all combined into one single price that you can buy, they typically are a more passive investment option, which means that the companies in them are bought and sold less, which also means that they will have less capital gains that they will distribute to their shareholders, which means that they will have less capital gains that will be distributed to you at the end of the year. You see, even if you invest in individual stocks or mutual funds, if the companies within those funds that you invest in buy and sell a whole bunch of times, then you may still be hit with a big tax bill, even though you didn't buy and sell your specific mutual fund at all. That is because the capital gains that the entire funds have to be distributed to the people who actually invest in that fund. So if the fund has capital gains, then you have capital gains as well. That is why if you're going to be investing in mutual funds, you want to try to invest in something that is passively managed, something that is not trying to beat the market by making a whole bunch of trades, because not only will they probably not end up beating the market, but you also may still be hit with an unexpected tax bill, even though you didn't sell your specific security and capture those capital gains in your own portfolio. And another lesser known way that you can reduce your taxable income is actually by investing in real estate. And how this works and how you can actually save money on your taxes by buying real estate is that the IRS allows you to depreciate any real estate that you have over a 29-year basis in order to reduce the value of that asset over time in IRS terms. So what this means is that if you buy a $100,000 house, you could depreciate that $100,000 house by 29 equal amounts until the value of that property is zero in IRS terms. And when you depreciate the house, you are basically going to be using it as a tax write-off and therefore lowering your taxable income just a little bit more. So with a $100,000 house, you're basically going to be taking about $3,500 a year. And this may not be the most popular method in order to save money on taxes, because you do have to spend money to make it. However, with real estate, ideally, you'll be making money in more ways than just the tax write-off. You'll be making money through appreciation. You'll be making money through cash flow if it is a rental property, and you'll be making money through principal pay down if you have a mortgage attached to it, as well as through the depreciation we just talked about. So knowing the ins and outs of investing in different sectors of the economy can help you save a lot of money on taxes as well. But with all that being said, I really hope you enjoyed this video, and if you found value in this video, then don't be afraid to tap that like button for your boy, as it really does help the channel out. My goal for this video was just to provide a high level understanding of how taxes work, but if you really want to get in the trenches of it, then I would definitely recommend contacting your local CPA to talk to your personal tax situation with a professional. But if you did enjoy videos and you want to see more videos like this, then hit that subscribe button. And also, as a treat, if you go down to the description of this video and sign up to the public app, they will give you a free stock just for using my link as a little bit of a present from me to you. However, that's all I have for you in today's video, guys, and I'll see you in the next one.